I have been working through something for 2 weeks that the financial media has almost entirely gotten wrong. On January 30th, 2026, one nomination announcement triggered the worst single day for silver since March 1980. A 31.4% crash in silver futures, a 9% collapse in gold. Headlines immediately declared the precious metals bull market dead, the debasement trade finished, sound money restored, and yet 2 weeks later, as I am recording this, silver is trading back above $82 and gold just made a record weekly close in London. The narrative that supposedly killed this market has not killed it. And when you look at exactly who Kevin Warsh actually is, what he has actually said in the past 6 months, what his confirmation process actually looks like right now, and what the structural forces driving precious metals actually respond to, the story the media sold you on January 30th starts falling apart in ways that are very specific and very documented. Let me start with exactly what happened that day because the sequencing matters enormously. January 30th, 2026. Silver had just crossed $121 per troy ounce, its highest price in modern history. Gold was trading near $5,600. Both metals had roughly doubled over the previous 12 months as investors positioned against dollar debasement, Fed independence concerns, central bank buying, and a structural silver supply deficit now confirmed at 6 consecutive years. The debasement trade, as Wall Street came to call it, was one of the most crowded positions in global markets. Speculative net longs in COMEX silver and gold futures were near record highs according to CFTC Commitment of Traders data from late January. Then at 1:45 p.m. Eastern, Bloomberg confirmed that President Trump was nominating Kevin Warsh to chair the Federal Reserve. Within minutes, silver futures were in free fall. By the close, silver futures had plummeted 31.4% to settle at $78.53, the worst single-day performance for silver since March 1980. Spot silver was down 28% at $83.45. Spot gold shed approximately 9% to $4,195. Gold futures fell 8%. The dollar index gained 0.85%. The narrative was immediate and wall-to-wall. Warsh, a known inflation hawk who dissented against quantitative easing during his time at the Fed from 2006 to 2011, would keep rates high. He would protect the dollar. The debasement trade was finished. Buy dollars, sell metal. That narrative had 3 major problems, and 2 weeks later, all 3 of them have surfaced in ways that validate exactly what the data suggested the moment the dust settled on January 30th. The first problem was leverage, not fundamentals. What the media called a fundamental repricing was, by the admission of multiple market participants on the day itself, almost entirely a liquidation event driven by margin calls and forced selling. Matt Maley at Miller Tabak said it clearly that afternoon. Most of this is probably forced selling. Silver had been the hottest asset for day traders and short-term momentum players in the market. There was significant leverage built up in the position. When the decline started, margin calls went out, and those calls required selling silver to raise cash, which created more price decline, which triggered more margin calls, which created more selling. That cascade is identical in structure to what happened in March 2020 when COVID caused equity margin calls that forced hedge funds to dump silver futures to raise dollars, sending spot price to $12 while physical dealers had empty shelves. The mechanism is not a fundamental reassessment of silver's value. It is a leverage unwind that produces prices that do not reflect the underlying supply and demand reality of the physical market. The ING Commodities Strategy team put a number on the scale of the overshoot. While the correction was overdue after the intense rally, they wrote, the scale of Friday's decline far exceeded most expectations. Morgan Stanley's quantitative desk reported massive forced rebalancing in leveraged ETFs, with SLV estimated at $3.5 billion in forced selling on the day alone. $3.5 billion in a single ETF in a single session. That is not investors reconsidering their view of silver fundamentals. That is algorithmic rebalancing triggered by price moves hitting leverage thresholds. When leverage unwinds, the prices it produces are not information, they are noise. And the recovery that has been steadily erasing that decline for the past 2 weeks is the signal. The second problem was the Warsh narrative itself, which Wall Street applied based on his 2010 and 2011 record, and almost entirely ignored his actual stated positions from the past 6 months. Let me walk you through who Kevin Warsh actually is in 2026, not who he was in 2010. Yes, during his time as Fed governor from 2006 to 2011, Warsh built a reputation as an inflation hawk. He dissented against quantitative easing. He was more worried about inflation than jobs, even in the aftermath of the 2008 financial crisis. That record is accurate. But his more recent views, the ones that actually matter for how he will run monetary policy as Fed chair starting potentially in May 2026, tell a substantially different story. In the months leading up to his nomination, Warsh repeatedly echoed Trump's criticism of the current Fed and expressed support for lower interest rates. He has publicly argued that productivity gains can boost economic growth without driving higher inflation, which means the economy can run hotter than traditional models suggest before rate hikes are warranted. He has criticized what he calls mission creep at the Federal Reserve and argued that the institution should focus more narrowly on its core mandates rather than using monetary policy as a broad economic management tool. Thierry Wisman at Macquarie Group, one of the sharpest analysts covering this space, put it directly. Warsh is not the Fed's guy. He is Trump's guy and has shadowed Trump on monetary policy almost every step of the way since 2009. That framing does not describe an ideological hawk who will aggressively raise rates regardless of economic conditions. It describes a pragmatist who has positioned himself to implement a policy mix the White House actually wants. Markets currently price the expectation of 2 to 3 rate cuts in 2026 with a 65% to 75% probability, according to analyst estimates as of early February. The idea that a president who has spent 3 years publicly demanding lower interest rates would appoint a Fed chair who immediately delivers higher rates and a stronger dollar is not supported by the political logic of the appointment. As the Bahnsen Group's analysis put it, Warsh is neither hawk nor dove in any simple sense. Limiting the Fed's balance sheet, while believing rates can come down if growth is non-inflationary, is a nuanced position that cannot be stamped into a single category. And yet on January 30th, every algorithm with the word Warsh in its headline scanner stamped it into a single category and sold 31.4% off silver in hours. The third problem is the most important, and it connects directly to what has been driving this market for 3 years. The precious metals bull market since 2022 was not built on expectations of a weak Federal Reserve alone. It was built on multiple simultaneous structural forces that are completely unaffected by who chairs the Federal Reserve. Central banks globally have been buying gold at record rates. The World Gold Council has documented this consistently. China's official treasury holdings of U.S. bonds fell again in November 2025. Russia, India, Poland, Turkey, and dozens of other central banks have been systematically increasing gold reserves as a percentage of total reserves. That process is not a trade on Jerome Powell's interest rate decisions. It is a multi-decade repositioning away from dollar-denominated assets by sovereign actors who have strategic reasons entirely independent of U.S. monetary policy for wanting hard asset reserves. The Silver Institute's confirmed 6th consecutive year of structural supply deficit does not care who chairs the Federal Reserve. 67 million ounces more demand than supply in 2025. India projected to import 220 million ounces in 2026, roughly 25% of global annual mine production, from a single country. Solar panel manufacturers drawing down physical inventory. COMEX registered silver at approximately 82 million ounces against March open interest that represents hundreds of millions of ounces in paper claims. None of those numbers change because Kevin Warsh was nominated. Not one. The physical market cannot print silver to fill a structural deficit. The Fed chair cannot produce silver ounces. The supply and demand reality of the physical market exists completely outside the jurisdiction of monetary policy. And yet silver fell 31.4% in a single day on that nomination. The gap between what the fundamental structural situation says about silver's value and what the paper market price was on January 30th tells you everything you need to know about how the paper price is formed and what it represents. It represents the positioning of leveraged speculators in futures markets, not the underlying supply and demand of physical metal. When that positioning unwinds, it unwinds with a violence that appears to be fundamental, but is actually mechanical. The price recovers because the physical market reasserts itself. That is exactly what has been happening since February 2nd, when gold rose more than 3% in Asian trading and silver surged 5.3% to 83.50 just 3 trading sessions after the crash. Now let me address the confirmation process because this is an active story that is unfolding right now and it matters enormously for the Warsh narrative. As of today, February 14th, 2026, Warsh has been nominated for 2 weeks, and there is still no Senate confirmation hearing scheduled. The reason is Senator Thom Tillis of North Carolina, a Republican on the Senate Banking Committee, whose vote is essential given the narrow majority. Tillis has stated publicly and repeatedly that he has no intention of allowing any Fed board nominee to move forward out of committee and to be confirmed until the Department of Justice investigation into Jerome Powell is resolved. The DOJ opened a criminal investigation into Powell related to cost overruns in Federal Reserve building renovations. Tillis and many other observers believe this investigation was initiated to pressure Powell into cutting rates and represents an attempt to intimidate the Fed chair into policy compliance with White House preferences. Tillis's position is that confirming Warsh before this investigation is closed would reward precisely the kind of political interference in Fed independence that the investigation represents. That creates a genuinely unusual situation. Treasury Secretary Scott Bessent announced on February 13th, just yesterday, that he believes the Senate Banking Committee will proceed with confirmation hearings after reaching an agreement with Republican senators. But Tillis immediately responded by reiterating on Bloomberg TV that he will not back down. "My understanding is that we are going to proceed with the hearing," Bessent said. "We could have a hearing all we want, but until the investigation is done, I still believe the initial inquiry was a flex to try to get the current chair to step aside," Tillis responded directly. And Tillis is retiring from the Senate when his current term ends, which means he has nothing to lose by holding firm. Here is what that confirmation uncertainty actually means for silver and gold. Powell's term as Fed chair ends in May 2026. If Warsh is not confirmed before May, which is now a genuinely plausible outcome given Tillis's firm position, Vice Chair Philip Jefferson would serve as acting chair. Powell himself has indicated his intention to remain on the Fed board as a governor until his board seat expires in January 2028. The person the market sold silver 31.4% in a single day to price out might remain an active voting member of the Federal Open Market Committee, regardless of what happens with Warsh's confirmation timeline. And even if Warsh is confirmed on schedule and takes over in May, the FOMC is not one person. Decision-making is distributed across a system designed to preserve independence with staggered 14-year terms for board members, independent appointments of regional Fed presidents, and equal voting rights across all 12 FOMC members. The Fed chair is influential in communication and agenda setting, but cannot unilaterally dictate interest rate policy over the objection of the rest of the committee. The market priced January 30th as if one person's nomination instantly and permanently changed the monetary policy trajectory of the United States, eliminated the structural silver supply deficit, reversed 14 years of central bank gold buying, and made de-dollarization irrelevant. Within 2 weeks, silver recovered 5.3% in a single session, and gold made a record weekly close. The narrative did not hold because it could not hold. The forces it was supposed to have reversed were not reversed. They were not even touched. Let me show you what the physical market was doing during the entire crash and recovery sequence, because this is the part of the story that received almost no mainstream coverage. During the January 30th crash, physical silver dealer premiums did not collapse in proportion to the paper price move. If genuine sellers were flooding the market to exit silver positions, you would expect physical premiums to compress dramatically as supply overwhelmed demand. That did not happen. Dealers continued charging 15% to 25% premiums over spot for silver eagles and maple leafs even as spot price was crashing. Silver ETF holdings, specifically the iShares SLV Trust, actually saw physical silver added to underlying inventory during the period surrounding the crash, even as paper price was falling. Physical demand did not validate the paper sell-off. It ignored it. That pattern has now appeared in 3 consecutive major silver sell-offs. March 2020, COVID-driven cash liquidation sent paper silver to $12 while physical shelves were empty and premiums were $10 over spot. September 2011, CME margin hike-driven forced selling crashed paper silver 40% while physical demand remained robust. January 30th, 2026, a single political announcement triggered a leverage cascade that sent paper silver down 31.4% while physical premiums held. In each case, the paper price produced by the sell-off was a temporary fiction created by mechanical selling pressure. In each case, the physical market refused to validate the paper price. In each case, recovery followed. The question that nobody in mainstream financial media has seriously engaged with is this. If the sound money narrative, the idea that Warsh will restore dollar credibility and end the need for precious metals as a store of value, was genuinely correct, why is gold making record weekly closes 2 weeks after the announcement that supposedly ended the gold bull market? Why is silver trading back above $82 when the crash supposedly established a new fundamental price level based on hawkish monetary policy expectations? The answer is that the sound money narrative was applied to a market move that was not primarily about fundamentals. It was about leverage. The leverage has unwound. The fundamentals have not changed. And the price is reflecting that with a recovery that the same outlets that wall-to-wall covered the crash have largely declined to cover. Here is the confirmation risk that makes this story particularly compelling right now. Warsh needs to clear the Senate Banking Committee before going to the full Senate floor. The committee has a narrow Republican majority. Tillis is the decisive vote. Tillis is holding firm as of yesterday. If Tillis does not move, the vote could fall along party lines and fail to advance Warsh out of committee, or it could be delayed for months while the DOJ Powell investigation drags on. Powell's term as chair ends in May. If that deadline arrives without Warsh confirmed, Jefferson takes over and the entire hawkish repricing trade that was applied on January 30th gets unwound in a matter of hours when markets realize the assumed transition never happened. That scenario, a confirmation failure or extended delay that leaves the Fed leadership question open through the spring, is bullish for precious metals by the same logic that the nomination was supposedly bearish. Let me also address what Warsh himself actually said publicly before his nomination about the issue that matters most to silver and gold investors. In November 2025, Warsh published a Wall Street Journal op-ed titled "The Federal Reserve's Broken Leadership," in which he argued that inflation is a choice made by central banks and signaled a desire to shrink the Fed's balance sheet significantly. Those are hawkish words on paper. But the same op-ed was also a sharp political critique of Powell, designed to position Warsh favorably with a White House that wanted a more politically aligned Fed chair. The political positioning of that op-ed and the actual policy content of it are not the same thing. A man who wants to be Fed chair writes what helps him become Fed chair. What he actually does, once confirmed, depends on the economic conditions he inherits, the political pressures he faces from a president who has demanded the lowest interest rates in the world, and the institutional constraints of an FOMC where his individual views are one vote among 12. The sound money narrative was compelling enough for algorithms to sell silver down 31.4% in a single day. It was not compelling enough for physical buyers to stop paying 15% to 25% premiums over that crashed spot price. It was not compelling enough to prevent a 5.3% silver bounce 3 sessions later. It was not compelling enough to stop gold from making a record weekly close 2 weeks after the announcement that supposedly ended the gold bull market. And it is not compelling enough to address the 6th consecutive year of confirmed structural supply deficit, the 82 million ounces of COMEX registered silver against March paper claims that represent a multiple of that, or the 14 years of systematic central bank gold accumulation by sovereign actors who are not making investment decisions based on who the United States Senate confirms as Fed chair. Kevin Warsh may be confirmed. He may move to normalize the Fed's balance sheet. He may approach monetary policy with more rigor than his predecessor. All of that may be true simultaneously, and the silver bull market's structural foundation can remain completely intact. The price of silver is not determined by Fed chair appointments. It is determined by the physical reality of a market where 6 consecutive years of demand outpacing supply has been drawing down above-ground inventories 1 ounce at a time while global central banks continue accumulating the assets that cannot be printed, cannot be sanctioned, and cannot be devalued by any single institutional decision. The Warsh shock was real in its violence and real in its damage to leveraged positions. The sound money narrative that was deployed to explain it was not real in its connection to the structural forces that built this market. 2 weeks later, the data is showing which one was right. The crash got the headlines. The recovery is getting the silence. That asymmetry is the story.